Good morning, everyone, and welcome to today's Tide Masterclass, how to approach investors to fund your business. This is now our 25th Masterclass in total and the 7th in our September series, how to start a small business. For September, we've changed things up slightly. We're now doing 2 Masterclasses a week, each being around 30 minutes and giving you that how-to guide of how to start a new business. Because of the time restraints, we won't be doing a Q&A at the end of the session, but if you have any questions, do please send them across to me via the email address, which I'll share in the chat room later, and we'll get back to those questions as soon as we can. So pleased to see a good number of you joining us live this morning, and if you're watching this after the live event on our YouTube channel or through our on-demand service, great to have you along too. My name is Kuhn Hawker, and I'm the event manager here at Tide. And for those of you who are maybe new to Tide, I just want to give you a quick overview of our services. So we're the fastest growing online business current account provider in the UK. We currently have over 200,000 members. Our aim is to provide our members with a service that saves them both time and money when it comes to their business banking. We're great for SMEs and for startups and for freelancers. And as there are no credit checks or startup or monthly fees, this also allows you to even try us out alongside your current business account provider to see how we can save you time and money. Sign up process, really quick and simple, takes between 5 and 10 minutes. And at the end of that time, you'll receive your sort code and account number so you can start banking straight away. And a few working days later, you'll get your Tide card through the post. The app itself, really simple to use and to get set up. There's a huge amount of in-app products as well, which make your banking life a lot easier. A couple of my favorites, the auto categorization tool, so you can see exactly where your money went and when it went there. And within the one account that you have, you're able to split that into 4 sub-accounts as well. So you can have a sub-account for your tax, for your marketing, for your events, for whatever it is that will make your banking life a lot easier. So I'm going to talk to you a bit later about how you can stay up to date with what we're doing here at Tide in terms of events and how we're going to make it a lot easier for you to become a member if you are not one already. But for now, let's get on with the masterclass for today. And really pleased to have George Bevis join us again for his second masterclass this week. Wonderful to have you, George. And as some of you may know, he's, among many other things, the founder of Tide. So it's wonderful to have him at today's masterclass. Good morning, George.
Great, thanks very much, Kevin. Yes, you're right. So I am the founder of Tide. It was 5 years ago we started the business. Feels like a long time ago now. But over the early days, so I was running the business through till mid-2018. I was obviously the one responsible for raising money for Tide. We needed to raise a lot of money because it's an expensive thing to build a banking business. And during that journey, I, across several different rounds, raised more than £10 million, and also prior to Tide, in another wildly unsuccessful business, raised around £200,000 of angel money, where I think I pitched 200 times for that business. It was a terrible business, so I had to pitch a lot to raise that money. But anyway, I've been around the houses a few times, raising finance, so very happy to give this talk today about what that experience is like. Perhaps we can move to the first slide. So I guess the key point I want to land is that often there's a perception that you can't get access to the best investors unless you've got an MBA from Harvard Business School, or you've got a parent who's some mega industrialist or whatever. And actually, that really isn't true. Almost no entrepreneurs have those backgrounds, and no entrepreneurs who get money from the top investors have those backgrounds. And I didn't have that background. So you can forget all of that. It is a relatively level playing field. And this is a list of ways in which you can build relationships with investors, which has the best approach, probably at the top, and obviously the one I discourage at the bottom. So let's go through it in order. At the top are accelerators. These are organizations which partner with very new businesses. Often it's just you've just got an idea. Maybe you've got 1 or 2 co-founders. You might have a product, but you may well not have a product yet. You probably don't have customers. So really right at the start of the journey. And accelerators will typically give you a bit of mentoring and a very small amount of money, and promise to introduce you to relevant investors once you're ready. Now, not all accelerators are created equal. There's a list of 181 of them in the resources for this presentation later on. I've named two here, Entrepreneur First and Techstars, that are particularly highly regarded. You do need to be careful with some of the others. If you work with an accelerator that's not a good one, then you're still going to have to give them a load of shares in your business. You're still going to have to invest time in meeting them and potentially being mentored by somebody who may not be a very good mentor. And then when they make introductions to you to investors, well, firstly, they may not do it in the first place, but even if they do, those introductions may not be very highly regarded because they may not be a strong brand accelerator. So the way to find out whether or not an accelerator is a good one is to ask the accelerator who their portfolio are, who the other companies are that they've worked with in the past, and then directly reach out to the founders and CEOs of those companies and ask them for views on the accelerator. Don't do it through the accelerator, because then, of course, the founders and CEOs will feel like they have to be polite. But if you reach out direct, most likely you'll get a response, and you should get a reasonable indication of the quality of the accelerator. Secondly, getting introductions from successful people you know. And I think the interesting thing here is that it really doesn't matter, in my opinion, what field those people are in. They could be in some quite unrelated fields, but if they have a strong relationship with the investor, that may still count for more than an introduction which is less highly regarded by the investor. So, for example, it's quite well known that lawyers love making introductions on behalf of startups to investors because it costs them nothing. As part of their job, they have lots of relationships with investors anyway. But typically it's the case that investors may not view lawyers or a referral from a lawyer as meaning very much, because lawyers do this all the time. Whereas the same investor might take the view that his friend, who is a brain surgeon, but who he or she considers to be a very impressive individual with strong taste in thinking about the world, may actually be a better way to get introduced if you know that brain surgeon. So don't be worried about whether or not the profession of the person making the introduction is so perfect. I think the key thing is the quality of the relationship, whether or not the recipient of the introduction really values the opinion of the introducer. Next on the list is sending cold emails. Now, this is very unpopular, or at least strongly discouraged by certain types of professional investors. But frankly, who cares? Because much as they don't want to receive huge numbers of emails, they'll never hold it against you, the fact that you had enough hustle to send them that additional email that arrived in their inbox that day, and you've got a chance and it costs you nothing. And that it is the case that there are some professional investors who do respond to cold email pitches. So if you can't get an introduction to a professional investor any other way, I think there's absolutely no shame in sending a cold email. It won't do you any harm, and in the off chance, it might do some good. And reaching out to angel investors, that is rich individuals, absolutely you can do that by cold email. Yes, angel investors, particularly the more prominent ones, do receive multiple pitches, but they don't receive so many that they won't have any chance of noticing your email. They will notice it. They'll take a look, and if they're interested, you might get lucky and you might get a reply back. In my experience, sending emails to those people who are sometimes called operators, that is the people who actually run businesses rather than the people who invest in them, is usually a bit more successful. So operators, for whatever psychological reason, seem to be more inclined to be helpful to strangers than at least professional investors. So don't be afraid to send emails to operators. There are various tools on the internet that help you guess the email of someone you found on LinkedIn. So do go ahead and use those. The next way of reaching investors is to turn up at events. Of course, a bit tricky in these COVID days, but in a normal year, that's a well-trodden route. I would, however, be wary Do this, you likely will end up investing quite a lot of time going to an event. There's time commuting to it, and there's time being at it, and there's time coming back from it. And you may only walk away with 1 or 2 or 3 business cards, and it may be that none of those business cards are terribly relevant, or the person who gave it to you wasn't actually interested in what you were saying and doing. I'm not suggesting there's no value in going to these events in terms of building a network, but I wouldn't overstate the value, and I think the other mechanisms I've described may be a more efficient use of your time if your objective is to build relationships with investors. Finally, there are lots of people knocking around who might say that they would act as an advisor. And if you give them a few shares, they will make some introductions for you. You should run a mile from those people. I've never met a high quality early stage investor who doesn't take the view that those advisors are typically time wasters and unhelpful. The early stage investors do not want to talk to an advisor or an introducer. They only want to talk direct to the founder, because that way they get the most efficient information flow and accurate sense of how the picture is, how the company is doing or may do in the future. And a lot of the people who present themselves as advisors and very well networked are shysters. So just don't go anywhere near any of those people. You shouldn't need to give away shares to get introductions. I understand why it may be tempting, but I really see the best connected people are very often in a position personally, economically, where getting 1/3% of your business is not going to make a big difference to them economically, and there's some paperwork involved in doing that, and they can't be bothered with it. So good people will not ask you for shares typically for making an introduction. So I'd be wary of anyone who asks for equity in return for introductions. Perhaps we can move to the next slide. So let's say you've got the introduction, you've got the pitch meeting, you've done the pitch, and it's hopefully it's gone okay. But how are you going to structure your communication with them to improve the chances of getting an offer of investment from them? Well, first off, be aware that investors' incentive is not to give you a clear answer on whether or not they're going to invest. Investors' incentive is to wait until they know how some other investors also think about your company before giving you a final yes or no decision. And that means that they may well drag out a process for longer than it needs to take. Now, the way to manage that, and by the way, you'll never fully correct that problem. There isn't a way to fully correct it, but the best way to manage it is to have in your head what I would call a private timeline, meaning you don't tell anyone else what it is, but you have a sense that you're going to do X number of pitches this month, and you're going to look for indications of interest by the end of the month, and then you're going to look to turn that into offers by 2 weeks after that, or 3 weeks after that, whatever it is. Have that in your mind. It's not a good idea to tell other people what it is, because of course if things go wrong, if you don't get any offers, then it's very embarrassing that you're still in the process months later begging for meetings. So don't tell people, have a private timeline, and then ask the investors to set their own deadlines. There's no reason why you can't, when you meet them, say, brilliant to meet you today. Can you tell me how quickly you think you can come to a decision on this? What would be the steps? Now, once they've volunteered that information to you, you can then hold them to that. So get them to set their own deadlines. You should expect to do a lot of pitches. I would expect to talk to, at least, if you can get the introductions, you can get pitches, try and talk to as many as, more than 10 different organizations or individuals per month, if possible. Before you turn up for the meeting, send either the full presentation or just send a one-pager. I think it's actually fine to do both. It is likely that the investor will have skimmed anything you sent to them, but it's unlikely that they will have read it in great detail. But it is useful to give them a sense of what it is you're going to be talking to them about, and it means that the quality of the conversation is a bit better. And in particular, if they know that on slide 13 you're covering a particular topic, then they're less likely to interrupt you on slide 2 to ask you about that topic, which can be annoying. Time wasters are a problem. As I mentioned, their incentive is to keep the process going for as long as possible before they make a decision. But even those who, putting that aside, there's other types of people in this process who actually were never going to invest in you, but they still chose to take up your time. They might be doing that because, for example, and it's sad to say, but it is often true, if they are an institutional investor, they may actually be looking at investing in your competitor, and they're using the pitch process to get information about you. It might be that although they're not investing right now because they haven't got any cash available right now, they anticipate that they're going to be able to invest in the future, and they're going to have more capital available, so they want to build a relationship with you now. It's actually not very helpful to you. It's still taking up a lot of your time. And there are various other reasons why your time might just be being wasted. So you need to identify the time waste. Questions to ask to achieve that include: what size of investments have you made recently? If they haven't made recently any investments of the size of amount that you're looking to raise, then they are wasting your time. Do you usually lead or follow at this investment size? It's quite important. Our lead investor is the main investor in an investment round. They're the ones who do the due diligence, and the other investors trust that main investor, the lead investor, checked out all the information correctly. It may well be that if an investor only ever follows, then really it's not worth investing a huge amount of time until you've got a lead. Be aware that large venture capital funds employ, particularly in the States, armies of 22-year-old analysts whose job, as far as I can tell, is only to populate a massive database with a big list of all the startups in the world, so that when those funds are raising money from their investors, they can say, we've got a massive database, therefore we're a good fund. Now, that is not the same, or indeed even related to them actually being likely to invest in your company. So overwhelmingly, when you get a cold email from a junior employee in a big US fund, also bearing in mind that US funds very rarely invest in particularly early stage businesses in Europe, that is what's going to be taking place. It's about filling up their database, and frankly, it's just not worth even talking to them. It may be tempting to ask investors for a non-disclosure agreement, an NDA, but the truth is investors hate NDAs, and they know that experienced entrepreneurs know that investors hate NDAs. And so in the main, particularly early stage, they just will refuse to sign them, and they'll think worse of you if you ask them to sign them, because it looks like you know the space less well than other entrepreneurs that they're talking to. This is unfortunate because investors do share around your decks. Some, not always, maybe not even most, but there are enough, and every experienced entrepreneur can tell you stories of when their investor has shown them slides from a competitor that they received as part of the investment process. This is not unknown, sadly. And you should assume in this process that there is going to be information leakage, that any information that you share, at least in the early pitch meetings, has a real possibility of ending up in your competitor's hands. You just need to accept that risk. Maybe consider what information you share, but I wouldn't be too tight about it. To be honest, the likelihood that a competitor will change their strategy because of something that you told an investor that the investor remembered and the investor remembered to pass on and was relevant for the competitors to change their strategy is not high. So I just tolerate the fact that you are taking that risk of information leakage. Now, when you are in the process of pitching, most likely, particularly if you're new to this, you're pitching somebody who is pretty smart and has done a lot of these pitches before and probably can find one or two holes in what you're saying, and that's okay. It's not the end of the world. It doesn't mean that they won't invest. And the tone to take when they spot something that you're saying that that might put you off key is what I think of as the Gwyneth Paltrow tone. So lots of people know that Gwyneth Paltrow has a wellness business called Goop. It's less well known that that business is venture capital funded, and she has been talking about the experience of raising venture capital and actually how it's very hard, and people ask her very difficult questions that she wasn't trained as an actor to talk about. So, of course, it's worth noting that if you're Gwyneth Paltrow and a VC asks you about your approach to discount capital discounting calculations, it is legitimate for you to turn around and say, no, I don't know the detail of that accounting formula, but I'm Gwyneth Paltrow, which is frankly dramatically more important for creating a business like Goop than whether or not you know some accounting formulation. And now, I think it's to be unlikely that Gwyneth Paltrow is watching this masterclass, but if you're anyone else, I would strongly recommend adopting the same tone. Remember, much as you may not know about some technical thing that the VC has raised or something else in the industry that you haven't previously heard about, you are nevertheless dramatically more expert on the space than certainly anyone else he or she is talking to today, and likely anyone in the world. So you should still adopt the tone that, no, I don't know the answer to that particular thing, but I have some other ideas. Remain confident because you're the Gwyneth Paltrow of your industry. It may well be the case, very, very likely, that investors will say something completely stupid to you. If they don't understand the space, because investors are quite often suggest stupid things. You never tell an investor that their crazy idea is crazy. You'll say, yeah, very smart idea. I will definitely consider that, and then just don't consider it. That's the way to deal with it. Be aware that much as one reads stories about some great entrepreneurs are really tough individuals, really gruff. If you're raising money from individuals, from angels, they may decide that the fact they just found you difficult to talk to and they didn't like you very much is a reason not to invest. So I would be tempted to be gruff with them. If you are naturally a gruff person, I think that is more tolerated by venture capitalists who perhaps care a little bit less about the personal relationship and are more interested in getting a return for their funds. Next, it is not a good idea to ever tell an investor which other investors you're talking to if they ask. Now, they may ask. They ask because then they will go and back channel to that other investor and find out that other investor is using you. That's probably not helpful to you. So don't name another investor until maybe you've got an offer from the other investor, in which case you can say X fund has made me an offer, although you may decide to keep that secret. Also, venture capitalists have some weird idea that if an entrepreneur answers the question of what should be the valuation of this business, that they are negotiating badly, because that stops the venture capitalists from offering more. In truth, I think most angels, and indeed most people whose brains operate independently, would say surely this should be helpful to the process, it just speeds things along. VCs do have this view that you should not disclose a valuation expectation. So when they ask you for one, they're testing you to see whether or not you know this little weird industry quirk. And so now I've told you, so now you do know. And so if a VC says to you, what's the valuation on this business? The answer is, the only acceptable answer is, I want to let the market set the price. After you meet the investor, particularly if they ask any questions that you said you'd get back to them on, it's fine to send a quick email follow-up within 24 hours. But don't feel like you have to send email follow-ups, and particularly not early on. You definitely don't want to look too keen in the eyes of these people. And particularly with VCs, any sort of signaling of your desperation is not a good idea. Can we move to the next slide? In terms of your presentation, look, I'm sure you already know that the deck, as it's often known, needs to contain information about the proposition, the product, the market size, how to get customers, competition, traction. So that bit is a bit obvious. There's often some question about where you mention who your team and who is backing you are. And the answer is, if they're really impressive people, then put them at the start, because that sets the tone. But if they're not particularly impressive, put it at the end. Be super clear about what the investment is going to pay for. So what's the stage on your journey that you will get to having spent the money that you're raising? And of course, include your forecasts. And the best plan on forecasts is to say that 3 years in the future, 4 years, 5 years, will have incredible growth and the revenue is going to be amazing. But this year, for some very good reasons, we're going to be cautious, and the projections are quite modest. The reason to do that is because after they invest, you will almost certainly underperform any confident suggestions you made in the next 12 months, and that's all anyone's ever going to remember. So just make sure that the projection for the next 12 months is more modest, but with a story in the back end about why you're going to be a big business later on. The most important thing in startups is that the lifetime value of any customer that you win should at least 3 times the cost of winning that customer. Make sure you spell that out really, really clearly in the deck. Investors will get stroppy if they think you're taking up their time on a pitch where you haven't done as much as possible up to that point already. So if you haven't already done cheap or free market research, you haven't got testimonials for potential customers, you haven't done financial projections, you haven't lined up some people who might potentially be team members or partners, if you haven't done wireframes and mock-ups, these are all cheap things that you can do relatively quickly, and you should have done. And investors will reasonably feel like, why should they be expected to invest and expose themselves when you haven't exposed yourself by investing the time necessary to do those things. And finally, keep it short. Serious entrepreneurs don't write lengthy Word documents with sort of 90 pages of content. I think a 10 to 15 slide presentation is quite normal, less than 1,000 words. And the sad fact is that investors are much more influenced by the quality of graphic design on your deck than one might hope, even though it has nothing to do with the quality of your business. It is something that differentiates you from all the other presentations that they look at. If we can just move on to the next slide, you'll see an example of that. So these are the decks that we used for Tide in our very first fundraising, 11 slides and less than 900 words. And when I raised £10 million at Series A, it was 13 slides and just 516 words. So you see lots of charts and quite a lot of effort went into the visual design there. And Kuhn, if we can move on to the final slide. Just to let you know that these are some of the questions that you should have answers for. How big can this be? How scalable is your business? Which usually means what the things are going to slow scaling down. Why hasn't someone already done this? What is the advantage that your business has? How much do your customers' behaviors need to change to use this service? Where do you think you can take the company in 5 years beyond your initial market and product? What happens if some big corporate copies you? What are the key hurdles to what you're doing? What's your exit strategy? Meaning, are you going to sell this business or float it on the stock market or something else? And finally, there can be some questions about you as an individual. What makes you special as a founder? And what is it that really motivates you personally to do this particular business?
Wonderful. That's great, George. Thank you so much. Just before we go on to the resources section that you discussed about, I just wanted to remind today's attendees that they'll receive an email from us in the next couple of days with a link to easily become a Tide member. On that email, you'll also have a link to rewatch today's webinar and share with your colleagues or your friends or family. All you need to do to become a member is click that link that I mentioned a second ago and download the app and follow the very simple instructions, and you'll be able to start using Tide for all your business banking needs. Also, in the chat room right now, I'm going to put the links to all of our social channels and the link to the resource that George is just about to talk about. If you're watching this on YouTube, all those links will be in the description below as well, including how to want to become a Tide member. So George, maybe, if you just wanted to talk through this resource, and like I said, the resource will be in the chat room right now.
Yeah, so this is a link to a very long list of all the different accelerators that are available to you. So do look through it in your own time and decide if you think any of those would be appropriate.
Wonderful. Thank you, George. It's been fantastic having you for our masterclasses this week. I really appreciate the time you've taken and the effort you put into the presentations for us. And we look forward to welcoming you maybe at a future masterclass. And thank you for the attendees for taking your time today to join us. So thank you, George, and thank you to the attendees, and we'll see you again soon. Bye-bye.
Thanks, Kieran. Bye-bye.